Money, in its various forms, has played a crucial role in human societies for centuries. But how is money actually made? In this video, we'll explore the process of creating money and the different forms it can take. Let's start with physical currency, such as paper bills and coins. The process of creating physical currency involves several steps. First, the government or central bank determines the amount of money that needs to be produced. This decision is based on factors such as economic growth, inflation, and the demand for money. Once the amount of money to be produced is determined, the printing and minting process begins. For paper bills, a special blend of paper is used, and the bills are printed using high-security printing techniques to prevent counterfeiting. Coins are produced using a similar process, with metal blanks being stamped with designs and inscriptions. However, physical currency only makes up a small portion of the money supply in modern economies. The vast majority of money exists in digital form, in the form of bank deposits and electronic payments. When you deposit money into a bank account, the bank is effectively creating new money. This is because banks are only required to hold a fraction of their customers' deposits as reserves, and can use the rest to make loans and investments. When a bank makes a loan, it creates new money by adding the loan amount to the borrower's account. This new money is essentially created out of thin air, and is backed by the borrower's promise to repay the loan with interest. In addition to bank deposits, electronic payments also play a major role in the modern money supply. When you use a credit or debit card to make a purchase, the money is transferred electronically from your account to the merchant's account. This electronic transaction effectively creates new money, as the bank issuing the card is able to create credit by adding the purchase amount to your account. So, to summarize, money is created in several different ways, depending on the form it takes. Physical currency is printed and minted by governments and central banks, while the majority of money exists in digital form, created by banks and electronic payment systems. While the process of creating money may seem complex, it is essential for the functioning of modern economies. Understanding how money is created can help us make better financial decisions and navigate the complex world of finance. The justification for governments creating money is a subject of debate among economists and policymakers. On one hand, creating money can help stimulate economic growth and support lending and investment. When the government injects new money into the economy, it can help to increase consumer spending and support business investment, which in turn can lead to job creation and economic expansion. On the other hand, creating too much money too quickly can lead to inflation and other economic problems. When there is too much money in circulation relative to the amount of goods and services available, prices can rise, leading to a decrease in purchasing power and potentially damaging economic growth and stability. Therefore, the creation of money by governments needs to be managed carefully, and policies that promote long-term economic growth and stability while minimizing the risk of inflation or financial instability need to be implemented. Overall, the justification for creating money by governments depends on a variety of factors, including the current state of the economy, the level of inflation, and the goals of government policy. While there may be valid reasons for governments to create money, it is important that they do so in a responsible and measured way to ensure long-term economic stability and prosperity.